Okay. Hey, everybody. Roll Tide. Let's see. T, you said in regards to the test, is there a particular area that you would want to look at? No. T, you overthinking it. Just tell me what you learned. Yeah, I mean, I think what you're doing is overthinking. Don't overthink. Just get in there and start writing. Hey man, here's what I learned. We listen to music every week. We do this, whatever. Now, I do need to ask you guys something. You've all got the information now to make yourself wildly successful, right? I really, really believe. Let's just rehash a couple things. So we know that obtaining wealth is simple, it's just not easy. But if you'll do something like this, if you give away some, if you'll save some, if you invest some, and you can live off the 70, you're going to be good. Now, if I was going to make any changes to this, now if you can increase your investments, 15 or 20 or 25 or 30, that's great. If you can't, this is life, right? This is life. The problem is most people think that the top three, not doing those, are what gets you in trouble. No, what gets you in trouble is number 4, because people can't live off the 70. So you're sitting there going, Bobby, I can't live off the 70. Well, that's because of credit cards and auto loans, and you got to have the nicest cars, and your house has to be spotless, and you got to have the greatest house because people can't come over if you're living in a double wide trailer, and blah, 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 blah. And what you're doing, this is what gets us in trouble, is trying to impress everybody. I mean, once you get that over with, then you can say, I don't got to impress anybody. Your life is going to be a lot more simpler. It really is. You just go, I don't care what people think about me. Now, when I was younger, I really cared what people thought about me. Now, I think it's something that we acquire as we get older. You see an old person in a grocery store. They don't care what you think about them. They don't care that they got their rollers in their hair and their chicken catcher hat on. They don't care. So, it's just really a great thing where you get to that point where you go, I don't care what somebody thinks about me. The other day, I took my daughter and we were going to pick up Wendy's for the family. So we go through the Wendy's drive-thru. And so the girl's taking my money out and I'm just singing, loud. And she's like, Dad, stop it. And the girl was just watching me sing, in the car. And she's like, stop it, Dad. I go to school with that girl. I said, well, now she's going to know that your daddy loves to sing, and we went the other day. She goes, I hope my friend's not at Wendy's drive-thru because she don't want her daddy singing. But I don't care. Do I care if I'm out of team? No. Do I care if they don't like the team? No. I just sing. Sing, 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 sing. Have yourself a ball. This is your life. This is your one shot. You got one shot. Now, Shirley MacLaine tells you that she's going to come back as a bald eagle or something. Yeah, I don't really buy into that. I think I got one shot in this life. And so that one shot, we got to give it our best. You got to enjoy yourself. You cannot walk around miserable every day of your life. What a horrible way to meander. So, if you are in a situation where you're depressed, you're not feeling good, this right here really will help you. Giving away. You say, well, I don't have any money to give away. Well, give away your time. Give away your time. Go volunteer at a shelter. Go volunteer at a soup kitchen. Go help somebody, right? Go help somebody. It's amazing when you do that.
You can run all these college students.
Let me mute everybody. Amazing when you go out and do that and start helping someone else, how better you feel. Get in the kitchen and cook some cookies and give it to somebody that's, not feeling well. It's simple. Doesn't have to be money. Just give away, a little bit of your time. So that's an investment in you, because we got to invest in ourselves, right? Got to invest in ourselves. I'm thinking I'm Mr. Greatest parent on the planet. I get to go to all my kids' things. So all 3 of my kids 2 adults and 3 kids playing ball yesterday. And they're like, this one's at field G2, and this one's at E4, and this one's at 7. And I'm like, there's 2, but how are we going to do all that? So, I go with JoJo, and Beth goes with the other 2. And, who knows how we split it up. And then I get there. And all these kids have these wonderful little duffel bags. They got their helmet. They got their gloves and their bats and their balls and their all this stuff. And I'm sitting there going, we didn't bring jack crap squat, because I'm used to JoJo going somewhere like football practice and just, he's been the fastest one and he likes to run. So I didn't even think about equipment. So now we got to go get equipment today. So I was really embarrassed yesterday. I'm like, I look around, I go, what kind of parent would not give a kid a glove and a bat to come out to baseball practice? Me, here I am, dummy. My kids had to borrow someone's glove, and I'm like, putting my head down, like, But hey, I was there, and my kids were fine, and they got to borrow gloves. And JoJo actually hit the ball 2 times, which I was very excited about. So, you got to have one shot at life. Give it your best. So you've already got the secrets to the kingdom. What are the secrets to the kingdom? Well, number one, if you'll put your money into equities are stocks, but not individual stocks. We're going to do a index, right? So it could be an S&P, NASDAQ, a whole market, whatever. So you're going to put them in equities, and you're going to either dollar cost average in, or you're going to twin invest in, or you're going to do some variation of putting money in every pay period so that you can grow your wealth. Now, anything above your equities is just to make you happy. Problem is, I don't want you to overdo it. So let's say you're putting something in an S&P 500 fund. That's where you're happy at, right? You're going to dollar cost average into that. And you say you got to have bonds. Remember, I'm not a big fan of bonds. I'm just not. But if you want a little bond exposure, get you a little bond exposure. Now, here's where you're going to overdo it. The more things you add, the less effective you're going to be. Because some of you think you got to have gold, and you got to have silver, you got to have oil, and you got to have wheat and corn and soybeans and pork bellies. Stop it. Stop it. Over time, equities is where the growth is. You want to add a real estate investment trust to it? Okay, go ahead. But keep it simple, silly. Keep it simple. Don't overcomplicate it. It's really, really easy. And over a course of a number of years, you're going to do just fine. Now, so figure out your allocation. Right. So, you're sitting there going, I kind of like the hedge fundy thing where, it's 55% equities. Now that's only if you're doing a leverage portfolio, which most of you will not do. Yeah, I would say that's for those that are younger and more aggressive or have a high risk tolerance like me. You could do that. But, find your little S&P fund, find your little whole market fund. Put it in that dollar cost average. If you want a little bond exposure, do that. But when you start going out and you get 15 asset classes, come on, people. Yeah, but Bobby, that's what my clients want. Okay, they may have different goals than you. What I'm trying to help you is with your investments to grow, not to, just do nothing. So it's really, really, really simple. Now, then all you got to do is say you got to have a rebalancing or reallocating schedule. Right? So whether you use AIM and Licello, now some of y'all kind of dissed on Licello a little bit, and maybe a lot of that's my fault because you only did it for one asset. Now, what you should go back and do is go back and do your AIM whatever, your AIM back test and do 2 or 3 different assets. So add a stock fund, then add a bond fund, maybe one more, and then run. So it really starts working good when you're using 2 or more assets, different asset classes. So what you will try to do, and I can't let you come out of here and just overcomplicate this thing. It's not complicated. It's just, this is the simplest thing you'll do. We just don't teach it to kids. We don't teach it to kids because we give them a million different investment alternatives. We give them, so many alternatives that they don't know what to do. So they end up doing nothing because it's too complicated. No, here's what it is. Put your money in every pay period, have it automatically drawn from your account into your 401k or your brokerage company, and just keep doing it. The more you touch it, the less effective you're going to be. So the more you get in there and the more you start fidgeting and changing and doing this, the worse you're going to perform. Just let it fly, baby. Over the long term, the SP 500 is going to be just fine. Doesn't matter what's going on in Ukraine or Russia or China or Taiwan or Great Britain or the United States. Over the long term, you're going to be surprised. That's going to do fine. That's where you put your money. You want a little bond exposure in that, do. Well, Bobby, don't I need international? Not really. I don't think. If you've got S&P 500, I think you're fine. You want a little international? Get you a little touch of international. I got no problem with it. Pick you a plan. That's where you make your money. Be an asset allocator. Allocate, rebalance, dollar cost average, invest, regularly put money in, and let time do what time does. And that's
Hey,
it.
Bobby, can I jump in here real quick?
Absolutely, Doug.
Awesome. Hey, during the Tom talk, you were talking about you felt like a lot of us were too conservative. So I think maybe this would be a good time to unpack what an ideal portfolio may look like, and what you kind of meant by that were too conservative comments, because I've been second guessing myself here, even though almost 100% equities. So I'd just like to get your thoughts on that. And if you're at Wendy's, that new hot honey sandwich is delicious.
Abby got it. Abby got it. And now the problem is with the hot stuff is the back of my head sweats, like right in the crown of my head. I mean, it's like a gusher of water. And it's like, I don't know why it does that. But as Abby was eating it, that's my daughter. She says, Dad, it's going to be too hot for you. But I'd love to try it because I love that honey, kind of a little bit of hot. She says it's a little bit hot for me. So can you believe I went to the Wendy's here in Bowden and I'm like, I need a baked potato because I'm trying to eat healthier, right? Eat a baked potato, and I didn't get any cheese or chili or anything on it, just a plain baked potato. Sorry, sir, we're out of baked potatoes. I'm like, the Piggly Wiggly is right behind you. How do you run out of baked potatoes? Go get a potato from the Piggly Wiggly. Yeah, but that's not where we get our potatoes from. I don't care where you get the potatoes from. You can't run out of potato, for God's sake. Okay, Doug, you got a great question there. Why do I think y'all are too conservative? Because I've been watching y'all, and keep in mind, I know I grade y'all's thing so quickly, you think I don't read. You have no idea. When I'm on the pot in the bathroom, that's what I'm doing. I'm on my phone grading y'all's papers. Exactly. That's where I grade and do a lot of my grading. I like to sit on the toilet and I'll grade papers. So I'm grading all your work that you're doing. And as I'm reading you, you're going, oh, this sounds great, but that's a little too aggressive for me. That's what I'm hearing from y'all. Then I give y'all the circle thing that I came up with. I've never seen anyone do that. That's my own little, personality test to figure you out. And most of you draw within the circle. So I know that most of y'all grew up to be risk averse. So Doug, you're almost 100% equities. Okay, that's good. Now keep in mind, I want you to be a little conservative because I'm not a proponent of the individual stock. So I don't want you guys to necessarily go out and think you're going to be the next Warren Buffett. You're going to pick the stock. So I want you to be, what's the perfect thing for most of you? Let's go back to Warren Buffett, S&P, baby. The S&P. You got 500 stocks in there. And if one of them goes bankrupt, you don't care because it goes down to $4.99, but they don't care because guess what? They're going to add somebody to make it 500. And who's that somebody going to be? Somebody that's darn good. What if 20 of them go out of business? You don't care because you got 480 companies. So if you talk to a lot of people though, well, you need at least 10 equities in your, no, you don't. You need the S&P 500, do a Vanguard fund. Now, if you're not going to do options, and selling options and doing things like that, then I would do a low cost fund. I probably will not do SPY. I would only do SPY if you're going to trade some options around it to kind of lower your cost basis. So the S&P 500, that's where you go. Now, the current book that you're reading, and I hope everybody's doing the reading. I told you in my little announcement, you can, lead a horse to water, but you can't make them drink. So if you're not doing the readings, you're missing out a lot. And I gave you an AIM reading, which are like, oh my God, they've got algorithms and all kind of stuff, a little complicated. Then we went to the 3% book, which is a little less complicated. It's kind of, a watered down version of AIM. And then we're really watering it down with the Path to Wealth book that we're reading now, where he just says, basically, put it in an all market fund and forget it. He's basically going a little bit farther with his diversification, and he's buying a whole market fund. And you can certainly do that. So either the whole market or the SPY, but pick what you believe in. Baby, I am all about the US of A. I believe in our top 500 companies. I also believe in the NASDAQ 100, but that's probably a little more risky for some of you. So, and then you go, well, what if I do SPY and QQQ, which is the NASDAQ 100? Well, you got a lot of overlap in those two, don't you? And that's what the problem is. You start getting too many stock funds in there, and you're going to get a lot of overlap. So pick you a stock fund. Which one are you going with? SP 500? NASDAQ's probably too aggressive for most of you. Then do an all market ETF or mutual fund with low fees, and go, baby. Just put it away. Now, don't tinker too much. Tinkering is what gets us in trouble, because we as human beings have what is called a shiny object syndrome. SOS, shiny object syndrome. And I have this a little bit myself, right? So you're sitting there going, okay, my 2011 Nissan Rogue is a great car, but man, have you seen the new blah, 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 blah? And then you start thinking, man, that's what I need to get. I need to get something new and shiny. That's why you see more than 50%, divorce rates in our country, because you marry somebody, then all of a sudden the shine wears off. And so we're looking for somebody that's new and shiny. There's always something new and shiny. Don't tinker. Set your program and forget it. Rebalance, certainly, that's fine. Rebalance quarterly. I think quarterly rebalancing is the way to go. Do AIM if you've got more than one asset in there. Do that. Run AIM every month. Do a quarterly rebalance. I think that was by far the best performing portfolio that y'all back tested. But do you know what is amazing to me? Remember when I said y'all were going to have to do more work, the rebalancers? Do you realize that I would have expected 33.3% of y'all to be in the group 3? But I'll bet you there was less than 5% in group 3. I think we got some sneaky people in here that said, hey, wait a minute. That fat, black glass, spam wearing, Elton John loving, 9-toed bastard just told me to, I was going to have to do extra work. I think I'll be in group 2. Whatever. Right? So, Doug, you asked a great question. Set it and forget it. Stop looking for the next great hot stock. Stop looking for Tesla. Now, some of you are degenerate gamblers like me. Right? You're the poker players. You're the. So here's what I would do for you, Doug. If you are in that category and you want individual stocks, okay, maybe allocate 5% of your investments to the fun stuff. What's the fun stuff? Well, the fun stuff. So in other words, you got fun money. My aunt used to have fun money. So she would go to work and she'd make the bills and she'd put money in, for the family and with my uncle. But then she said, I keep fun money. What is my fun money? My fun money is going to the bingo hall. My fun money is going to Philadelphia, Mississippi and playing the slots. My fun money is buying Bitcoin. My fun money is trying to pick the next greatest stock. Absolutely. As long as you plan for it. As long as you plan for it. So you don't want your entire portfolio to be the dessert. You want a little bit of fun money in there. Now, what's my fun money? Y'all probably have already figured out, I love these leveraged ETFs. I love them. It's a lot of fun for me to play with. I don't need Bitcoin because I have enough movement of, an asset going up and down through the leverage ETFs. But for the majority of you guys, I think, set you a stock fund, go with it. You want a little bit of bonds in there, make yourself happy and make you think you're doing something fine. Overall, that's probably going to have a lower, lower return because bonds overall don't go as, good as equities. And right now is a really good, if y'all have not started, now's a good time to start your dollar cost averaging in. Why? Because we are in a bear market. Now, are we in a technical bear market where, Joe, whatever has said it's got to be this month? I don't know. I don't keep up with that stuff, but we're in a bear market. How do I know we're in a bear market? All I got to do is go to my little thing here. And all I see, this is the E-mini S&P 500. Look, my linear regression channel is, Bobby, I thought you don't use technical indicators. I don't, but I like a linear regression channel. Hold on a minute. Let me get me this Keltner channel. Let's see what I got. Load chart set up. Let me show you what linear regression. This will make it simple. Linear regression. How do I know we're in a bear market? Because my linear regression is shooting downward. Look, what's this? Ta-da! See it pointing downward? That's TQs. So TQs. Let's do SPY. Ta-da! SPY. See it pointing downward? To me, that's a bearish market because the slope is downward. Okay. So the slope is downward. I think we're in a little bear market. So now's a great time to put in while the stuff is down. Now, here's my question. Doug, did I answer your question? I don't want to give you I don't want you coming out here and going, Bobby said do this. I want you to think. I want you to have.
Yeah, you did. I mean, I think you would probably define me as aggressive, but when you started talking about people not being aggressive, then I'm like, well, man, should I be putting some more money in the TQQ? To me, that seems very aggressive.
It is very aggressive.
I would lump that into the 5% fund money. Can I ask one more question about that?
Sure.
I didn't quite understand the discussion around the downfalls of holding that over a long period of time. So I guess where I'm getting at is I've been trying to talk to my buddies. If we have a 25% correction, why wouldn't we dump 10 or 20 grand in the TQQ and just hold it and see what happens? But I don't understand the downfall of long-term holding.
You would. The downturn problem with holding is most people don't have the stones to hold.
Okay.
That's the only down problem. Yeah, you're exactly right. Buy and hold it.
Okay.
Now, at some money, when you're a multi-millionaire out of it, I would go, well, let's take a little bit out, take a little price. And that's what Lucello tells us. That's where you say, okay, he's telling to take a little, meat off the bone and, put it over on the side and in the freezer for a cold day when there is no food. Because that's the problem, right? Like, in other words, you wouldn't want your TQQ portfolio, all TQQQ right up to the day you retire, because what if we did have a 20% correction on the day you retire?
Right.
But yeah, the TQQQ should be some fun money for y'all. Y'all need to say, I need a 5% of what I'm doing into that TQQQ or UPRO, which is the S&P 500 equivalent, 3X, right? All right, someone else had a question?
I have a quick question about that. Using your spreadsheet of when to buy and when to sell.
Yep.
How is that affected by wash sales? Do they always take first in, first out? How is that done?
Well, the good thing about a wash sale, the good thing about the AIM, first of all, let me tell you what a wash sale is, y'all. It's a stupid little rule. What a wash sale means is that you're in something, right? And then you dump it at a loss, right? You've lost on it. So you dump it and then you jump back in before 30 days passes. So let's say that it's December the 31st and you're out trading and you're going to dump all your losers so that you can count it as a tax loss. And then on January the 2nd, when the market opens back up, you buy back in. So the IRS realized that, hey, people are trying to scam us. So to avoid a wash sale, you got to wait 30 days after you dump an asset before you get back in. The good thing, Beth, you're going to love this with Lucello, you never have to worry about a wash sale. Why?
that's my question. Because if you're following that spreadsheet, you learn when to buy and when to sell.
So Lacello algorithm only has you to sell an asset at a profit.
Gain.
Yeah, at a gain. So you never have that problem.
Okay, that's a great point.
And keep in mind, if you don't want to do AIM, I would say do quarterly rebalancing. Quarterly rebalance, go into your 401k, your TSP, rebalance it quarterly. And you never have to worry about that. Why? Because you're doing it quarterly, not before 30 days. So if you're going in and, you know, changing things up every day or everything, yeah, you're going to have probably some wash sale problems. Don't worry about it. AIM will never give you a wash sale problem because you're only selling when something has gone up and you're having a profit. Good question.
Great point. I didn't think about that. I forgot about that.
Good question. Beth, that's why I'm here, girl. Yeah, no, I'm kidding, right? Because I don't know everything. I don't know a lot. I don't know a lot. I am still learning each and every day. I'm just telling you what works best for me. Y'all know what worked best for me. Little old young Bobby, 18, with a job in college with the federal government, and Bobby has the wherewithal to put everything into the C fund, the SP 500. Year after year after year. Come .com bubbles, come the housing crisis, come coronavirus, come it all, and I just kept on going, baby. I never stopped. And that's what you do. It's math and discipline, and it's more discipline than math. The math will take care of itself. Find you an asset class that you believe in long term. I believe in the American corporation. And we got all these people out here that hate the American corporation. Oh, they're so evil. Oh, they're so bad. Okay. Got it. But guess what? They're going to be successful in the long run. I'm buying from Amazon every day, just about every day. Guess where Beth got the bag from that we now, our kids will have nice little bags at our next practice because we were the family that didn't have a bag. I saw them all, and I'm like, God, how did I forget this? They need a glove. Dumb Bobby, because I'm too worried about accounts and finance. I'm that guy when the wife and husband are walking along the beach and she's thinking about, oh, how great Bobby is. And we're sitting there and, you know, she's like, oh, my life is awesome. And I've got a stock chart in my head going, oh, I just love it. So you got to keep in mind, this is my passion. This is what I love. I am engaged in the study and mastery of markets. It's what I do. This is what I think about at night. This is what I wake up at 2 a.m. and I go, wow. You know, I just have these little revelations. This is what I love. I love this. I love my family. I got my priorities in line, but as far as a passion of what we do, as far as our, you know, people say, what do you do for a living? I hate that. I hate, you know, this is what I do for a living. I don't do nothing for a living. I do things that I'm passionate about. So if you'll have the wherewithal to just do it, pick you an asset class or two. Don't pick 10. Don't because you're thinking, I'm going to be safer with 10. No, you're not. You're going to underperform the S&P 500. Just make it simple. And I understand wanting to have a bond mix, and I understand the hedge fund, the excellent adventure deal with having a little bit of bonds. And it makes sense because it's crash protection. But you've got everything you need. Doug, you've got everything you need to be successful. Brad, you've got it. Lisa's, you've got it. Kyle, you got it. Y'all got it. All you got is just discipline and math. Psychology and math. Just do
Hey,
it.
Bobby,
Yeah,
I have a question about, can you hear me?
Yeah.
So I'm in the library right now. So one of the things I liked about the 3% growth book,
Yeah.
which I finished, I guess, a week ago, was that
Yeah.
it seemed to me to use its baseline, it was kind of optimistic about the market because the baseline assumes that over 50 years span, the market grows by so-and-so. And so we're going to attack we'll sell not whether the money is above our initial principal, like with AIM, but whether it achieved a certain rate of growth, and if it underachieved, that's when we rebalance. Is there, do you think AIM sort of thinks about market optimism like that? It seemed to me to work out really well when you buy high and there's a slump. But if the market just kind of continues to go up, AIM to me seems to lose some of its power.
It underperforms, doesn't it? Which is why, if we talk about it a little farther, here's where I think AIM did really good. For the group 3, the ones, the 3 of you that were in group 3 out of 50, I look, the group 3ers found out that y'all beat the crap out of group 1 and 2. Now, the only thing different that they did, Kyle, was they added a quarterly rebalance. So the aim in conjunction with the quarterly rebalance. Now, it still underperformed buy and hold during that tremendous, bull market. But keep in mind, if you had done buy and hold and you're holding 100% TQQQ, you never had the cash to go in and buy when it was down. So that was kind of the cool combination, was running AIM on a monthly basis, 2 months, AIM, quarterly rebalance, AIM, quarterly rebalance, which worked out really good because that allowed you at least to convert some of your shares to cash, that you would then have that cash to buy back in rather than just to buy and hold. So, and it may behoove some of you to go back and try that. If you were in group 1 and 2, or get with some of the guys that were in group 3 and say, hey, would you mind sharing your spreadsheet? And, y'all collaborate a little bit, do a little back testing on it. See, that's what I like, Kyle, is that you guys are thinking, right? You're thinking, hey, wait a minute, 3% does this, the AIM does this. So is there a perfect strategy coming out of all this? No, because now you're on the path to, wealth, which is very simple. Just put it into the one fund and the total market fund and just forget it. You bought the whole market, forget it. Just make it really, really, really simple. Really, really, really simple. And the simpler you make it, the more successful you're going to be. My key to my success was putting it into the S&P 500, just dollar cost averaging it. And that's what I did. It's real simple.
Bobby, quick question. As we're reading through these different books, each of the books kind of has its own idea, its little philosophy, but it also seems to have its own way to calculate stuff. And you got to go to the back of the book and then go to a website for like the 3% signal. I was on there and they have a 3% signal calculator, but it looks like we have to subscribe to that and it's $200 a year. There go some of my gains that I just got by reducing the fees in my account. Do you have access to like the 3sig calculator, or do you know any other way to get that?
You know me and spreadsheets, Brad. I'm working on it. So y'all keep in contact with me. I'll have it. I'm going to do it. Right. I've already done the Twin Vest. I've already done AIM. When I have time, I'll do that. Right now, I'm mad at Uncle Sam because I'm working on my taxes, and I've been working on them for like 3 weeks. I can't understand why they're so complicated. So I'm mad at that, but I'll work on that. I'm a little bit.
Okay. I was gonna reach out to anybody that was in, this is just my first semester in this program, and I was reading back through where some of the folks were in the Excel spreadsheet class. I didn't know if maybe they had access to it already, or if they had done something like that. There were quite a few folks that are in this class that had that class before.
And that's what if you guys want to collaborate, that would be great too. See, that's the great thing about this. I just got to figure out how to put you all together, right? Because you meet here. I don't know how to get you all together to where you guys can. My wife was telling me something about something called, was it Group Me or something? I don't know, to where you guys can collaborate and work on projects. Wouldn't that be great that you get out of this class and y'all are still working on, developing these models that kind of help you to do what to do. For example, I've already built a rebalancing thing for you. You can do AIM, or I've got a quarterly rebalancing tab on there that'll rebalance it for you. Tells you exactly how many shares you should buy or sell to rebalance to whatever percentage you want to do. So these tools just make it easy, because keep in mind, I never rebalance. I just 100% S&P, 100% S&P. Let's go. And if that's you, you can do that. But if you want, if you've got 2 assets or more, you're going to have to rebalance back to something. And looking back, quarterly works really, really, really good. That way, you just got to touch it 4 times a year and forget it.
Hey, Dr. Gaines.
Yes, Tracy.
Oh, I'm so sorry. No, I was just going to answer Brad's question real quick.
Yeah.
About the spreadsheet class. I was in it last semester, and we didn't do anything as far as like what the 3% would have had us do in that kind of class. It was a lot of just like very general equations and very like just kind of like a basic understanding. It wasn't getting really far into that kind of stuff.
I mean, and if
Thank
y'all
you,
want to, if y'all want to help me with it, I mean, we could all work together on making that happen. Take our existing spreadsheet, my baby, and improve upon it by adding, the 3% in there. Now, I'm a greedy capitalist pig, right? I was going to change mine to like the 9% with my leverage ETLs, but all right. So here's my question. Y'all know how easy it is. You are not stock pickers, ladies and gentlemen. If you ever get out of here and say you're a stock picker, I will say, depart from me. I never knew you. You were never in my class. If you ever get out of here and you recommend to somebody a 60-40% stock to bond portfolio, I'm gonna say you were never in my class, because that's what the people who don't think do, right? Oh, let's just do a 60-40. No. It depends. Depends on what you want to do. Your asset allocators, your resource allocators. All of us, regardless how much money we do or do not have, are working on scarce resources. So you got to allocate those resources. And I like allocating my resources to a horse in a horse race that I think is going to do well over the long term. She may stumble right out of the gate, but over the long term, my horse is going to be just fine. Pick your horse, go with your horse. Stop changing it up. Now, maybe you have a yearly little, come to Jesus meeting where you say, okay, let's look and let's, but if you overlook it, you're going to abandon your program and you're going to try to jump on the next wishy-washy, shiny thing that you hear about. Stop it. Just stop it. Stop it. Now, we know how simple it is. Allocate your assets, pick you a fund or two, or three if you're, and rebalance quarterly, use AIM, use 3%, whatever you're gonna do, and just let it go. That's how simple it is. It really, really is simple. And that's what I hope you come out of this saying, oh my gosh, this is the most simple thing. How come I didn't know this before? Because they are having you look at the fundamentals and all this, and you don't need that. Pick the horse that's done well in the past that we believe, and have some logic for why you think the horse is going to do well in the future. The SP 500 is going to do well in the future. How do I know that? Well, Bobby, what happened? I always get these questions. What happens if our economy stalls for 20 years like has happened in Japan? Okay, I got it. Could it? Well, possibly. But name something better. Name a better horse that I would be than the 500 top companies. Apple, Tesla, Amazon. I mean, these are the companies I do business with. These are the companies that are going to do well. And if they don't, it's a self-cleansing fund. They get kicked out. They get kicked out and replaced with other up-and-comers. Where else can you have that? I mean, it's not like you're picking 500 companies and you got to worry about one of them going bankrupt because, then you got to pick another company coming. You ain't got to do it. The S&P will do it for you. They'll get the next up-and-comer in that S&P 500. 500 largest publicly traded companies in the United States. Isn't that great? You don't even have to repick the new winner coming into the fund. And you don't have to worry about booting the loser. They do it for you. Self-cleansing. You're an underperformer, you get kicked out. You're an overperformer, we welcome you in.
Hey, Bobby, do you
Yeah.
have an opinion on like target date retirement funds? Like I like them because they're simple, and I've always thought that if your target date was, if you're a more risk averse person, you just pick a slightly earlier target date retirement fund, and if you're a little bit more tolerant of risk, you just pick one a little later, right? Like that's just kind of a simple workaround there.
Yeah, target dates are fine. I think for me, they were a little more conservative than I would like, but y'all know my risk tolerance, right? So for most people, it's fine. So what I would do is, let's say if I was in a retirement fund that had a projected retirement date of 2030, and that was my projected retirement, I would probably, let me make sure I'm doing my math right, I would probably change my fund to say that I was not going to retire until 2040 based on my risk tolerance. So that it would be more aggressive. But so I'm okay with those. I mean, if you want to just do that, set it and forget it, I still think for a lot of people, it may be a little too conservative. But again, Kyle, I don't know your risk tolerance. You got to say what, so yeah, for someone that's more risk averse, yeah, do that. If you're taking on more risk than me, you want to try that, then, move your retirement date down, so it's still aggressive, a little more aggressive. But I still like, being predominantly in equities, maybe a little bond exposure, maybe one other thing, and that's it. Just do it. But good
Hey, Bobby,
question.
real quick with Kyle's question. I looked into a whole bunch of that. So I spent hours the other day. I pulled up funds from Schwab, Vanguard, BlackRock, American funds, and I compared target date funds to their total market funds, the Russell 2000, and their S&P. And if you're going to be going into those, definitely look at the expenses, the load that they each carry. The target date funds were significantly higher. I mean, some of them were pushing 1% compared to 0.1% for a lot of the S&P funds. And it seemed as your risk tolerance climbed, so as the years got further out, the 40, the 50, the 60, the expenses became even more. I don't know if those expenses will go down over time, but it's just something that I noticed in those funds.
Yeah, I noticed. I actually looked at Vanguard's funds recently, and their 2055 target date retirement fund actually has a lower expense ratio than their international total stock market index fund, which amazed me. So at least Vanguard anyway. I know you can get it as cheap as 8 basis points for a target date.
Good. And that's the thing we really learned with the retirement gamble, right? Is that you got to look at fees. Ooh, you got to look at fees. Okay, Tracy, what's your question about the leverage products?
No, I do what little personal trading I do through Charles Schwab, and they have like a little disclaimer on their TQQ saying, not suitable for most investors, represent unique risks, including leverage, derivatives, and complex investing strategies, and they're not meant to be held overnight. So I was just curious about, how that works. I'm just not really sure.
So that language that they're giving you, Tracy, if you can see my board, is called CYA.
Right.
Anybody know what that is?
Cover your butt.
Cover your butt, cover your ankle, right? So yeah, and I kind of joke a lot of times when I'm in the triple leverage stuff. You remember the old Smokey and the Bandit song, we're going to do what they say can't be done. So yeah, they're covering their butts there. That's exactly what they're doing. Now, could they go to zero? Theoretically, yes. If you're in the hedge fund, the excellent adventure plan, the 5545 with UPRO, and the thing, could both of them go to zero? I guess technically, do I think that's going to happen? No, I do not. So yeah, but I definitely do take risks. Now what I do, here's the cool thing too. So let's talk about the hedge fund, the excellent adventure, the 5545. And Bobby here thinks we're in a bear market. Of course, it doesn't matter. So if I'm in the HFEA 55% UPRO, 45% TMF, so in one of my RAs, I think I've got 1,031 shares of UPRO. What am I doing, Tracy, to reduce my cost basis?
I'm not sure. My brain's overloading.
I'm selling calls. Do you realize that on 1,031 shares of UPRO, I sold maybe 30 Delta calls last week and brought in $1,000? for a 7-day option. Guess what I'm doing again this Friday? I'm going to sell another 10 calls. Guess how much money I'm going to bring in? Another $1,000. Guess what I'm going to do next Friday? I'm going to sell another 10 calls and bring me in another $1,000. Yeah, Bobby, but what if UPRO goes up above your call? I will lose on the calls, but I'll make it on the shares. And keep in mind, 10 calls only covers 1,000 shares. I got 31 shares that are not even covered. Run, baby, run. Run, baby, run. Now, let me ask you this. I can go really deep into options. I can show you some cool stuff, but maybe y'all don't want the cool stuff. I mean, I'm willing to take this anywhere y'all want to. If we're going to buy a fund or two and that be it, then that's all we have to do. What do y'all want to do? Or do y'all want to know the cool stuff? Not saying that you'll ever do the cool stuff, but where do you want to go?
Cool stuff.
How many want to do cool stuff? Don't they have a little hand raising thing? Dr. Brent, how you feeling? You good? All right, I don't want to give y'all crap that y'all don't want to use. You know, I don't want to give y'all crap that I want to use. But I would love to show y'all something else. I'd love to show y'all how my portfolio was up 208% in March of 2020. God, I'd love to show y'all that. And I'm not saying that you guys are going to do any of this stuff, okay? Just keep it in mind. We're having fun here. We're learning. We're thinking, right? And isn't it great that you're finally in a class where we're not so worried about the grades and we're not so worried about, oh my God, I got to do this and that, and and you got to cheat off of Chegg or what's that other one that kids cheat on their online test. That's why I tell professors all over the place, you are a bunch of lazy sacks of trash because all y'all do is give these little, multiple choice questions. Your students are taking online exams. They're going to the internet to find the answers to these questions. I know they are. So why not give them an essay question? So we can really, really knock it out of the park. Oh, by the way, one of y'all was supposed to share. I left you a comment and I said, I want you to share your test. Who did I tell that to?
That was me.
Beth, will you share it real quick, like?
That was about the retirement gamble?
I don't know. I told you I wanted you to share something. Was it
You
your?
really did. Like, I got a gold star. I felt really good about that.
Oh my gosh, yeah, you knocked something out of the park. Well, while you're finding that, and it's really, really good. And y'all have to remind me, right? Because this is the only class you probably have that comes in that a professor doesn't have notes. I don't have notes on what I want to teach you. I don't have outlines. I don't have all that garbage. We just come in, we just try to learn something that you'll have a takeaway. All right, until then, let me hit the stop my recording button for just a second. Am I not recording? Where's my recording at? Yeah, pause recording. Harry Chapin, who had never heard that song before? I got a feeling some of you had never heard it. Anybody? Raise your hand or tell me. Okay. Tracy, you never heard the song?
I've heard bits and pieces of it, but I've never listened to the words of it.
Uh-oh, JoJo came here for a teledoc appointment. Come here, Joe. Come tell everybody hi. Hold on a minute, y'all. This is Joe Willie. Joe Baby.
Hey, JoJo.
Say hi to Joe. You got to go back to school now, baby?
No.
No? Okay. So, Tracy, what's the song about?
It's about a dad who has a kid and he keeps telling him, I'll be with you in a minute. I'll be with you in a minute. And the kid grows up and he's like, I'm going to be just like dad. And he is. And it sounds like there's a lot of regret at the end of it because the dad's like, I could have had more time with my kid. And he grew up to be just like me.
And they will, won't they?
Yeah.
They exactly will. If I'm not going to his ball games and, spending time with him daily and, doing whatever, then he's going to do his kids the exact same way that I treat him. So it's really, really, really important, that we have that life work balance. And the problem is, and y'all know the case, is so many people just hate their jobs. And think about it. You know, I commuted 4 hours a day for, 25 years or more. Crazy. So that's time I can never get back. Fortunately, I'm a late blooming father, so to speak. So I'm getting to spend these wonderful years with my kids now. Yeah, and I was pretty good at making sure that I was at all their stuff, but so many times I would, I was gone at dark. I would get home at dark. You'd eat and then you go to bed. So you gotta get things in line. That's why I like the trading and the investing thing, because I can do this wherever I'm at, right? I can do this by the pool or at the beach or wherever I'm at. I can, manage my accounts. I just love that. Anyone else got a take on the song at all? Kyle had never heard that before. Wow. Charlie,
I think
that
it's
was
ironic that he wrote the song and then he died very young and missed a lot of opportunities.
yeah. And that in and of itself is a tragedy itself. Have I shared the other Harry Chapin song with you about Roses Are Red? I don't think I have in this class. We'll share that too. Harry Chapin, it's a great song that goes along with our, reading between the lines. But now let's talk about the strategy of the wheel. Okay, let's get on to it because Kyle brought that up. So y'all want to do some stuff. Now this is forgive me, y'all. I don't know how to do paper trading because I do very little paper trading. So hopefully we can figure this out. Okay, so this is probably what your thing looks like. So most of my stuff is, I do real accounts. So this is going to be unusual for me, but I'm going to show you what I want you to do. Okay. And basically you're going to be running the wheel in your account. You're going to be running it on SPY. Okay. So here's what I want you to do. I want you to go into SPY and I want you to open up the options chain under the trade tab. Right. And I want you to go, normally we do this on Fridays. But so this Friday, you're going to have to do something on your account. But until then, we're going to go to the March 4th expiration, which is Friday. And this is a trade that I would have typically put on a Friday. Okay. So while you're, looking here, so it's got bid, ask, last, net change. So you're sitting there going, holy cow, how do I change this? So hopefully I can see this. So we're going to go option theoreticals and Greeks. Uh-oh, y'all can't see it. It's on another thing. And we're going to do, I want to change one of these to delta. All right, so y'all see that's delta. And then bid ask, you always want to keep the bid ask. And let's change this last, go to option theoreticals and Greeks. And let's change that to probability of in the money, probability ITM. There you go. Now, when is the best day to sell a put, y'all?
Is the idea that you sell it on Friday because then there's 2 more days for the market or for world events to shape the market before the market opens up again?
Well, the cool thing about doing it is that we have something called Theta Decay. And we'll go over the Greek so that you guys know all that. But I do it on Friday because I like doing a 1 week expiration. Now, I do this on my covered calls. Now, I'm doing it this time because I want you to have a larger number of occurrences. How do you spell occurrence? Occurrences. Right. I want you to get a large number of customers. So if we just did 45-day options, then you're not going to get very many occurrences. So if we can go and do 7 days, that's going to get you a few weeks. We got what, about another 7 weeks together. So if we can do this, you'll have 7 weeks of running through the wheel, which is going to be awesome for you. So here's what I want you to do. Now, the best time, Kyle, to sell a put, and I'm going to say ideal, is when the market is up or down. Christiana. Anybody want to try it?
Down.
Down. Very good. Why? Because when the market goes down in the asset that you're selling the put on, you can get farther away from the price. And what happens too with puts is kind of cool. And I'll show you this. We don't really have time for it today. I want to get you into the mechanics of doing it, and then I'll break it down while we're doing it. When the market is down, this is a balloon, which is your put. When the market is down, volatility increases. Volatility increases and blows the balloon up. So if this is a put that you could have sold on an up day, maybe you could have sold this put for $1. But when the market goes down, you could sell the same delta put for $3. That's called put skew. That's skew. That is, the skew increases because of rising volatility. So today we've got a really big down day, 1.72% down in SPY. It is a great day to sell a put. All right. So I want you to go to this third 3 days to expiration. You can do this today if you want to. If you're watching the video, you can do it tomorrow. You just sell the 2-day put. And I want you to go to the 30% probability of being in the money. So you're selling an out of the money put that has a 30 delta. That's what I call it. Now, you'll see the delta is a little bit different, but I normally go by probability of being in the money. And you want to sell one that's going to be about a 30 delta, 30% probability of being in the money. I'll use those terms interchangeably. And you're going to collect $2.88. So let's try that. So I'm going to sell, don't do 10 of them, just do one. So let's change that to 1. All right. So here we are. We're selling a put, $2.90. So that's for 100 shares. So I'm going to get $288 minus my commissions. I'm going to collect a credit of $287. My break-even price on SPY is $418.12. If it goes below that, I start losing money. My max profit is $288. My max loss is $41,812. This is why people don't sell options. But if I bought stock at $429 and it went to 0, what's my total loss? $42,952. It's going to cost $7,000 in buying power, which is a lot. Resulting buying power for stock is going to be 184,000, blah, blah, blah. So let's run the order. Let's see if we can get filled. So I hit confirm and see. Sold, baby, sold. So now we have sold the 421 option. Now, here's what's going to happen on Friday. Here's what I want you to do on Friday. On Friday, it depends. If the price of SPY is under 421 by a penny, we're going to be assigned 100 shares of SPY at $421. So that's a big meatball, isn't it? That's so what we would generally do is it depends if we're running the wheel. So I do want you to take assignment. Don't do anything, but let it take assignment. I don't want you to do anything Friday. I don't want you to sell any more options. I just want you to see if it expires or now, if the price of SPY is up here, 426, and it doesn't look like it's going to be bound there, then you can say, well, yeah, let's just let it expire worthless, or you can do something that's called rolling. But I don't want to get too convoluted yet, and we'll work again on this on Friday to show you what to do. So everybody sell your put in SPY. Okay. You say, well, I've already got one sold way out there. That's fine. Let's sell another one because we're specifically going to wheel this one. So we sold the 421. Now let me show you how pretty this looks in Tastyworks. You all need to open an account with Tastyworks, even if you don't put money in it, just because the graphics are so good. So here's SPY. We're going to the 3-day, and we're going to sell a 421 put here. So I want to see what this looks like. Review and send. Here's what I like. Look, this has a probability of profit of 79%. Do you remember what Tom Shoshnoff said? He said you can increase your probability of profit if you will what? Limit your profitability. What's he talking about? Well, if you buy stock, it's a 50-50 proposition. If you sell a put, you've got a 79% probability of making at least 1 penny in profit. Now, if you want to manage this trade early, you've got a 63% probability of getting at least 50% profit on the selling of the put. And we'll talk about all this other stuff later. I don't want to tell you about theta yet. I don't want to tell you about, but look, your maximum profit is 277 or 276, whatever the price is times 100. That's 275. So by limiting our max profit, we can take something that otherwise is a 50-50 bet and increase those probabilities to 79%. Now, let me tell you something. If you're a baseball player and you're hitting 790, you're going to do great. All right, so let's look at this now on the little curve here so that we can see it. Curve, so you can see this, but here it is. And it's great. Shows you what this looks like with SPY. Let me zoom in a little bit so you can see. All right, so here is your put. The green area is the profit zone. So if price keeps going up, doesn't matter. You're going to make max profit at expiration. If price goes down, you don't care. Look, it's currently at 431. You don't care if expiration, it goes to 430, 427.5, 425, 422, or down to your strike price. Look at that. At expiration, you still make maximum profit. Isn't that cool? So if it goes down, of course, you have losses here. Okay, but let's look at it and see what's the difference between this. Let's take a screenshot. Take a screenshot of this, the little profit zone and everything, and let's look at it. So you've got limited profit, but a 79% probability of profit. Now let's look at buying shares. So let's clear this order. What does it look like if you were to just buy shares, right? So that means you would click on the ask. So you're going to buy 100 shares. That has a 50% probability of profit. What's the chance you could close it at 50%? Well, 50%, right? Now, keep in mind, people buy stock all the time. Remember, we had a $40-something thousand max loss that went to zero. You still got that. If you buy the shares, then it goes to zero. Now, let's see if we can see what this looks like. This is the difference. Does everybody see the difference? You lose money day one if the market goes down even a bit. Look at that. You make money if it goes up a bit here. And this has unlimited profits. So you can have unlimited profits, but keep in mind, you're only going to have a 50% probability of profit. Isn't that beautiful? Can you imagine? You could have gone to investments class and never known this, that, hey, I can increase my probability of profit by limiting my upside. So let's bring this up. Why will you not come over? Here you go. Look at the difference in the chart. I would much rather limit my profitability to the upside and increase my probability of profit to 80% rather than 50%. All right, so everybody's got an assignment. Your assignment, if you so choose to accept it, is to sell a put and SPY at a 30% probability of being in the money. Get filled on that, just do one. You don't have to send me a screenshot or anything, but we're going to run through the wheel. So we've got another class on Thursday that will give us a better indication of where the market is. And we will then adjust that trade to figure out what we're going to do for Friday. And then you'll have a Friday assignment as well. Is this kind of cool for y'all? Do y'all like this? This good? Okay. Any questions about anything at all?
Hey, Bobby, is there a ripcord on this though? Like if it did start to take a precipitous drop, is there a way out? I mean, because on the other one, you don't have to ride to zero. Do you have to on this?
I mean, no. I mean, and we'll talk about, I don't use stop losses. A lot of people use stop losses. I manage my portfolio in a way that stop losses are not necessary. I got hedges in there. So is there a, yeah, I'll show you how to do that. But keep in mind right now, Dr. Brent, what we're trying to do is run the wheel. So the wheel is, we are perfectly fine with buying 100 shares of SPY. We're bullish. We're just going to improve our cost basis. Instead of buying it at the, what is it, 431 now, we're going to try to buy it at 420. So you're reducing that basis by $10 a share, which is sweet, especially if you're bullish anyway, right? So yeah, but we'll show you. And I think as we go along, you're going to be like, oh my gosh, this is, you mean you don't panic about these things? No, that's the worst thing to do. You don't panic, you just manage trades. And so by us doing this together, then we'll be able to do this. Now, let me do one other thing. I need to show y'all what I want here, down here. I need to do, well, we'll do that on Thursday. I've kept y'all long enough. But you've got one assignment, sell a SPY, put 3 days to expiration, expiring this Friday. We will look at it Thursday. We'll manage the trade and we'll see if we're going to get assigned shares. If we get assigned shares, we're going to sell a call against it. Y'all are going to have the most fun over the next 7 weeks. We're going to just massage this thing. We're going to massage it. We're going to reduce our cost basis and we're going to have a really, really good time. And plus, I'm going to show y'all some other trades rather than the wheel. We're going to get a little bit into some hedges. We're going to get into some futures. We may even do some gold futures, you know, just mix it up a little bit. We're having a great time with your portfolio. And we're going to build a portfolio over the next 7 weeks. Any other questions before I let you go for the day?
Yeah, I have like a conceptual issue with, so when when you sell a stock, that somebody is buying that stock from you. So when you sell an option, I'm just kind of confused how you can, I'm sorry, option terminology still frustrates me a little bit. I gotta read up more on it. I'm just kind of confused how the option can expire if somebody else has bought it from you. Isn't it their decision what to do with the option?
They are the ones that have the right to do so. You and I, by being an option seller, have the obligation to do so. So by buying options, if any of you follow on Reddit, the Wall Street Bets people, they buy options. They are buying options. They're basically giving themselves a 50% chance of being right and a 50% chance of being wrong. By selling options, you and I become the insurance company. Why would somebody buy a put in SPY? Well, we don't know exactly. It may be part of a spread. We'll talk about spreads later. It may be that they're buying a put in order to hedge their otherwise long portfolio. So we're there. We're the insurance company. We're Geico, baby. That's who we are. So I just sold a put that I don't even own. I do not own anything. How can I sell something that I don't own? And that's a little hard to figure out. I used to be like, wow, that doesn't make sense. How can I sell something that I don't own? Well, it's because I have an obligation to do something if all hell breaks loose and it goes against me. I have an obligation to be put those shares. I have an obligation to take on those shares. But over time, would you rather be Joe Q Public or would you rather be Geico? We're Geico. We sell options. We have more than a 50% chance of winning. The odds are in our favor. Will the house burn down and we'll have to pay off on the insurance at some point? Yeah, some point. But we know the probabilities. I just sold an option with a 70% probability of being out of the money. So and then when you put it under the thing, it actually says my probability of profit is almost 80%. So we're now the actuaries. We're the insurance company. We're letting the odds be in our favor, which is something you really can't do buying stock. So yeah, I just sold an option to somebody and somebody bought it and they're hoping the market goes down. And I'm hoping that the market goes up, stays the same, or goes down a little. Which one would you rather be? If you buy a put, You only make money if the market is one direction, and that is down. When I sell an option, I don't care if the market's up, sideways, or down a little. The only time that I get into a little bit of trouble is if the market is down significantly. That's why it's always better, if you can, to sell an option on a down day. The market's already down, 1.7%. Great day to sell a put. Great day to sell a put. All right, any other questions? Lisa Benton, you're quiet today. What's up?
Hello. I'm multitasking. I'm working and listening, sorry.
Okay, no, that's fine. I'm doing the same thing. Y'all can't even tell it. I got JoJo behind me trying to, I don't know what he's trying to do. Joe, what are you trying to do, baby? All right, y'all have a good day. Sell your put, and I will see y'all Thursday.